let's talk about the banking system generally, and then Silicon Valley Bank specifically, so we understand how to manage the balance sheet at a commercial bank and what Silicon Valley Bank did wrong and how they got caught, so to speak. How the bank, how would a good bank with performing, a good, let's say on Tuesday of last week, they were a good bank. By Friday, they were out of business. Cotton-headed ninny muffins. Thank you. Thank you, Denise. Yeah, that's what I was looking for. Okay, cool. So let me clear this up. I think I framed it fine. So let's talk about a commercial bank. This is a bank that lends businesses money. Okay? All right. So you got a bank, and they have a balance sheet. Okay. All right. Now, if I remember correctly, it's the formula is assets are equal to liabilities plus capital, bank capital. Is that right? Yeah, I'm pretty sure that's right. All right, so let's then let's now build a balance sheet then. So you have assets, liabilities, and then down here is bank capital. Okay. And these two sides must balance. But that's why they call it a balance sheet. Okay. Okay, cool. Bank capital, liabilities, assets. Okay, so a depositor comes in and deposits $1 million. Or let's just say $100, because it's easier to write. Is the $100 deposit an asset or a liability? Please answer. Think about it. A customer comes in and makes a deposit of $100. Asset or a liability? Well, it's an asset because the bank now has $100 in the vault. But it's a liability because the customer can come back 10 minutes later and say, give me my money back. It's both. Ha ha ha. So, shiny scratch and sniff sticker for you. What was your favorite scratch and sniff sticker? Mine was gasoline. Anywho, so now we got a balanced balance sheet. Okay, it's an asset because there's cash in the vault, but it's a liability because the customer can come in at any moment and ask for their money back. Give me my money. I'm withdrawing my money. So that, well, it's a liability. It can become a problem, right? All right. So how does a bank make money? Well, the next thing they can do is they can convert this capital and they could buy, let's say, $20 in bonds. So cash minus 20. bonds plus 20. What's happened to the balance sheet? Has it gone up? Has it gone down on one side, or is it balanced? Okay. But let's say they're collecting a 4% yield every year. Let's say a year goes by. Okay. You end up making money on the bond, right? The face value of the bond hasn't changed. It's still $20. But at the end of the year, there's 80 cents, right? All I'm trying to suggest here is the bank makes these investments and earns a return, like a carry trade. There might be a cash position, but if you're earning a positive yield somewhere, that's revenue for the bank, and that goes under bank capital. Okay? So this is a decision for bank managers. Now, this bank is also required to park some money at the Fed and all kinds of stuff. But there's some managerial decisions that go in here that the bank manager makes. For example, what if the bank says, well, we're not making much money. 80 cents on our $100 isn't a lot. So why don't we sell or convert another $60 in cash into bonds? What do you think? Is that a good managerial decision or a bad one? And then you decide to do another 10 because that's making good money now. What's the problem here? Now we're talking about Silicon Valley Bank. What's the issue here? Now, these bonds are actually U.S. Treasuries, incredibly low risk, guaranteed by the U.S. government, incredibly liquid, and currently paying a very high yield. What's the problem? Isn't that good? That's a good portfolio, isn't it? So they're making good money over here. Pa-ching, 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 exclamation point, money, money, money. Okay, they're making good money here, right? Now, James brings up the point. Okay. James says it's not a problem unless somebody asks for their money back. So what happened is, and I think it actually started with FTX, which is interesting, which took down some investments into the crypto space, which took down some investors in the crypto space, as well as startups in those crypto spaces. And they all these venture capital firms and portfolio companies, they all have their money at Silicon Valley Bank. So what happened is Silicon Valley Bank had way too much investments and not nearly enough cash, as James points out. But these are U.S. Treasuries. They're super liquid, and they're earning good money. They're very, very, very safe. Excuse me, gee whiz. So what's going wrong? What's going on here? Well, Silicon Valley Bank was way, 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 way too aggressive in the amount of cash they had invested into treasuries. Now, they are safe. I have no problems with that. But here's the thing. Do you remember I said about 2 or 3 weeks ago, we looked at the market and we found out 99.6% of institutional investors disagreed with my point of view. And very, very clearly, Silicon Valley Bank was adamant that my point of view was clearly wrong. You could see, by the way, they managed their money. They thought interest rates could not go up, that the Fed was done. In fact, the Fed would cut. And if that happened, this portfolio would be performing extremely well. Well, it turns out they're wrong and I'm right. Okay, so what happened, because they were so aggressive in purchase of treasuries and so, I guess, dovish on the Fed policy, they didn't hedge. Let me say that again. They bought treasuries, but they didn't hedge because, according to their trading strategy, there was no way in hell the Fed was going to continue raising interest rates. So they didn't hedge. They thought there was zero chance. Remember, at the time, 99.6% of traders, institutional traders like a bank, thought, well, I was wrong and that the Fed would not raise interest rates. How do you hedge? Well, there's all kinds of ways to hedge, but imagine they own treasuries. So you could sell futures for the 10-year T-note. You could probably enter into interest rate swaps. But my point is it's normal operating procedure to buy the treasuries and then to hedge the risk. Totally normal. As managers of this bank, they decided not to hedge. But they also, the other way of looking at it, Rajil, is that you would never have as many treasuries as they did. So they were short cash, long bonds, and then they never hedged, because why would you hedge if you thought interest rates would not go up? So here's the thing. Let's move to the next point. Why did they fail? All right. Well, they have a portfolio of bonds. Think of it this way. And maybe this is why they didn't hedge. They bought bonds and they anticipated holding the bonds. Gee whiz. Sorry. They anticipated holding the bonds to maturity, in which you would not lose money. Okay? They were going to hold all these treasuries to maturity. Now, they might be 6-month treasuries, they might be 1-year treasuries, they might be 2-year treasuries, but they had no plan on selling any of them, in which that money was safe, guaranteed by the U.S. government, and they were guaranteed a yield. So what went wrong, everybody? They have a good portfolio of low-risk investments producing a very high yield. See, treasuries haven't yielded this high. Think of it as coupon payments, right? You haven't earned this much money from a U.S. Treasury in like 20 years. So they loaded the boat. So what went wrong? Well, interest rates went up and up and up and up and up. Okay? And the yields went up and up and up and up. But what happened is when they bought, let's say maybe a year ago, okay, they bought a treasury and let's say it paid 1%. And then 6 months later, a similar treasury paid 2%. And now similar treasuries pay 4%. And Silicon Valley Bank, I guess, thought that that was over. Okay? And while the Fed is still raising interest rates. What happens? Well, if you hold the bond to maturity, nothing happens. So so let's say this purchase here. If you bought $60 worth of treasuries, you're going to earn, let's say, 3%. And let's say it's a 1 year. So 1 year later, okay, you've earned your 3% of $60, plus you get your $60 back. And that's guaranteed by the government. So you're going to get your $60 back, right? The problem is this. They get a phone call from a client, or I guess you just now pull out your cell phone and instead of calling the bank, you just use the app and remove the money. The problem is they get a redemption, a withdrawal. They're like $80. Uh-oh. There's only $20 in the vault. Or actually, in this case, there's only $10 in the vault. Okay? There's only $10 in cash. Okay, this is the good part. Now, this is Silicon Valley Bank on Wednesday going out of business. Remember, they're out of business by Friday. So what happened? They got a withdrawal for $80. There's only $10 in the vault. What does the bank do? What does the bank do? It's got a balance. So let's do this. Minus 10 from cash. Okay. So now we're 70 short. Minus 70. Okay. Then what does the bank do? Sell some bonds to cover their losses. Well, remember, they didn't plan on selling the bonds. What's the big deal? Well, when this $60 bond that they bought 6 months ago is now worth less because in the last 6 months, the Fed has raised interest rates a lot, from 2% to 4%. So the value of this $60 bond is low. So you could do the math on it, and it's just bond math. But let's just say this bond now is selling at $45. Because think of the logic. If you could buy a brand new one at 4%, why would you buy this one at 3%? Well, really, you're indifferent if it paid you the equivalent of 4% by selling you the bond face value at a discount. Because remember, when the bond matures, you get the $60 plus the 3%. So you say, well, if you earn $60, 3% of $60 plus you save $15 buying it, so now you get the $15. So $15 plus 3% would, if you do the bond math, add up to 4%. Now, obviously, it's not 45, but I'm giving you an idea that there's a negative 15 somewhere here. So now, right? So the bank then dumps some of these and loses money on the bond. Okay? So they sell all this. Okay? They sell all this. You lower the assets. And now somewhere there's a minus 15. Okay? So now the bank has only got 20. Okay. That's a 2. Okay. 20. And all this is gone. And and now this would all have to balance where they had the cash. So I guess they don't have a bond portfolio anymore. And there's a negative 15 here or something. Okay. And that's when the Fed steps in, because now the bank has negative capital. Okay. So how does, okay, we'll answer that again. So how does a bank hedge? Okay, so anyways, that's what I wanted to tell you. That's the bulk of it, where there's a balance sheet, assets and liabilities, plus bank capital. They should all equal. And that it's normal for a bank to convert cash into bonds and earn a yield, because that's how the bank makes money. Okay? And that if there's a bond portfolio that isn't hedged, or they have too many bonds and not enough cash, what happens is then a very, very, very safe investment that's supposed to last, buying a bond that a treasury, government treasury that you intend to hold to maturity, all of that is good. And normally what would happen is you would have enough cash in the vault for a rainy day. So let's say as a bank manager, any given day, let's say, when I say 100, that could be 100 billion in deposits, right? And let's say any normal day you get 5 million of deposits and withdrawals and deposits and withdrawals and deposits and withdrawals. Meanwhile, you're supposed to take some of that, park some at the Fed and all that kind of stuff. Like there's this process. And as a bank manager, you say, well, on any given day we receive you receive on average 5 million in withdrawals. And then you're like, on extreme days, it's 15 million. But that's very unusual. And you're like, and usually it's a coincidence, or maybe it's the end of the quarter. And if you're Silicon Valley Bank, maybe that's when a lot of portfolio companies are withdrawing stuff. But nonetheless, you get normal ebb and flow of deposits and withdrawals. And you should know, the mean, and let's say 1 and 2 standard deviations from the mean. So you can say, if the average is 5 and you do 2 standard deviations from the variance, then you can find out there's a 96% chance, right, that withdrawals on any given day will not be above 15 million. And there's only a 2% chance of 18 million. Okay? So how much cash should the bank manager hold? And that's the bank manager's decision. And what the bank manager decided to do is hold way too many bonds. And so then there was a withdrawal, right? There was a negative here. And so they had to sell these to get this, to pay that. But they were selling the bonds at a loss. So now they're losing money here. The company, the bank as a company, goes insolvent. In particular, that they had some cash, I imagine, but then another company came in and withdrew, and another one, and another one. Then the CEO went on TV and said they had a problem at the bank and they needed to raise capital by selling more stock. Not just diluting the current owners of the company, but they just broadcast to all the venture capitalists that the bank is failing. So all the VCs came and said, give me my money back. Okay, so now you have the deposit here. Give me my money. Give me my money. Give me my money. Give me my money. So what are they doing over here? Selling bonds at a loss, 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 selling bonds at a loss. The bank is losing money. The bank is losing money. The bank is losing money. The bank is out of business. Okay. Rajneel says, I heard the Silicon Valley Bank failed because something to do with fractional reserve, and they didn't hold any reserves and invested the money into bonds. Well, this is what I'm telling you. So part of this would be your Fed deposits and stuff like that. But yes, this is what's happened. Now, the next question that Maida brings up, and thank you for the $2, Maida. Appreciate that. That goes into Wayne's Wine Fund. Okay. Silicon Valley Bank, if they had thought that interest rates are going to rise, they would say their bond portfolio's at risk. Because if interest rates rise, as I showed you, bond math tells you the price falls. So that a 1-year bond with 365 days on it. So you buy a brand new treasury sold to you by the treasury today. But you can also buy a 1-year bond sold by the treasury to a different investor 6 months ago. So you could buy the seasoned treasury that someone else bought 6 months ago. There's half as many days left. And it pays a significantly different yield. So if you do the math, it should get to the equivalent of today's bond. How do you do that? You have to lower the price. Now, again, if you hold all the way, if you buy the fresh cut 1-year treasury with 365-day life to maturity, well, you get your money back in 365 days. So again, in the open market, the price fluctuates every day. But if you don't sell it, then you're not mark to market. It's like the value of your house changes every day. It goes up and up and up, but you don't get to spend the money. The only time you get to spend the money is when you sell your house or borrow against it, of course. But that's just different form of leverage, right? So think of it this way. Let's say you couldn't refinance your house. Let's say you couldn't take out a HELOC. Let's say the only way to get that money when Zillow says your house is doubled in price, you don't get it until you sell your house. Now you don't have a house, but now you've doubled your money. You see? A bond is like that. If you don't sell it, even if it's worth less in the open market, it doesn't matter. When it matures, you get that face value back. Cool. Not a problem. But if you're forced to sell it when the market is down, then you lose. You see? So anyway, so it was this idea that Silicon Valley Bank should have realized that interest rates were going up. And then they look at their bond portfolio and they're like, okay, all these assets in the market are losing money. Because you could just look at the price of these bonds. Bonds are down, yields are up. It's all in the open market. Everybody knows this. Okay, the cash value marked to today's market of that bond portfolio on Tuesday. Remember, they started getting in trouble on Wednesday. So Tuesday of last week, or let's say 1 week ago on Monday, the value of this bond portfolio at Silicon Valley Bank marked at Monday's market value was low. Now, even if they didn't intend to sell them, they should realize that those investments marked to that day's market are losing money. And somebody, a risk officer for sure, should have said to the CEO, dude, if anybody asks for their money beyond the mean, so if we have a 1 standard deviation day, instead of 1 million or 5 million in withdrawals, it's 15 million in withdrawals, we will be forced to sell some of these assets at a loss, and you're going to lose money. So a bank manager should say that the bank should use futures, okay, or forwards of some sort, like a swap or a futures contract, okay, to hedge this bond portfolio. Wayne, please discuss how Silicon Valley Bank could have hedged. That's it. Okay, futures or forwards. I suppose you could do options or swaps and all these different things, but there's futures and forwards. So let's talk about that. A future, okay, a future is a contract that's standardized. Futures, okay? So imagine a baker wants to buy wheat for flour. So I guess it's not a baker. It's someone's going to sell flour to a baker. So it's a mill. So the mill has a choice. They can go to a farmer, and that's a forward. Okay? Okay, so the mill goes to the farmer and says, we want to buy 1,322 bushels of grain. Okay? 1,321 bushels of grain. And that's directly between the mill and the farmer. Now, that you could do this in all kinds of things, including financial assets. Now, a future is the same thing, but it's not really a farmer directly. It's through an exchange. Okay? And the exchange matches you. But with which farmer? Do you care which farmer? Probably not. Okay? And so the contracts, let's say, are sold in 100 units each. So you could go to a farmer, negotiate 1,321 from this farmer, but then the risk is, what if the farmer doesn't deliver enough? What if at the end of a year, because remember, you're saying in September, I want 1,321 bushels. Well, what if the farmer at the end of the year only yields 1,200? Uh-oh. Okay, so that's the risk there. So what was invented after that was a standardized contract where there might be 1,000 farmers, each contributing to liquidity of this grain. And now this mill could go and just say, give me 13 contracts delivered for September. And now they don't have the risk that the one farmer can't deliver it. It might be 1,000 farmers that could easily deliver 13 contracts. Okay? So that's the difference. Futures are standardized, and it's all organized in an exchange. Thousands of farmers with thousands of users of grain. And a forward is a custom contract between party and counterparty. So anyways, with that in mind, futures and forwards could be used. Options and swaps could be used to protect the bank. Okay? So a hedge means if the value of this bond portfolio is falling, then the bank has already bought those hedges, which means they're making money on the hedge. But they're still collecting the yield. So now they're not making or losing money on the price, but the bonds are paying a yield, and that goes over here. So if the cash portfolio of bonds loses money, the bank has it covered with their hedge, and they can make this whole again. It balances. Plus, the bank collects the yield at the end. And so, right? Nice. So it seems that two problems at Silicon Valley Bank occurred. One, they were way short on cash relative to a normal bank. So that was a bank manager's error. They were wrong. The second thing is, because they didn't hedge, the managers of the bank predicted interest rates would not go up further. Once again, they were wrong. That's a bank manager error. Third, they thought they had enough cash to cover withdrawals and that there would never be a situation in where they would be forced to sell that bond portfolio at a loss. So they thought the chances of a run on the bank were low. Well, they were wrong. Again. And within 48 hours, the bank failed, which means, okay, this bank had no bank capital. They were forced to sell, let's say, all their bonds, and at a loss. So the bank has no money, and there's probably less cash than deposits. So they're probably down to, let's say, $60 here and $100 there, where we started. Okay? Meaning the bank is insolvent. They can't pay their rent. They can't pay their phone bill. They can't pay their employees. There's no money at the bank. They lost it all in the market. And cash doesn't, right? Cash in the vault is less than what they owe their customers. And that's probably where we are. Okay. James says, your insights and the examples used to explain the problem is greatly appreciated. Cool. My pleasure. And that's what's going on. Assets right now do not equal liabilities plus capital.